and good day, everyone. This is episode 24, Getting Your Edge, How to Right Size Your Home and Life podcast. And we're here with Libby Carr, and she's going to talk about insurance. Not exactly our people's number one topic, but gosh, is it important? Before we get started, I just want to let you know that we have other episodes of this podcast that we'd love to have you visit. We also like to have you like, follow, and comment on this episode or any other episode of this podcast. Those likes and shares and so forth really help us build an audience. So my co-host here is Judy Gratton. Hello, Judy.
Hello, Dennis. Hi,
All right.
Libby.
Hey there.
So let's get going, Libby Carr. Give us some information about who you are, the name of your company, and what you do.
Okay, thank you. Thank you both so much for having me on today. I really appreciate this chance to talk about my business and get to know more people. And the name of my business is Carr Financial Advocates. I'm primarily in the insurance business, and that meaning being life insurance, annuities, disability income, and long-term care are the types of insurance that I'm licensed to sell and have been involved in for about 25, 30 years. And I also have a financial education seminar that I'm currently revising a little bit, but soon we'll be offering it again to the public. And with that, Dennis, could we put up the graphic?
Absolutely.
This sort of gives a frame for where I'm coming from and how I like to work with clients. And
There.
yeah, so several years ago when I was designing my financial education seminar, I know that often people use the term or the idea of saving for one's nest egg, and meaning how much retirement, creating a pool of money that they can then draw on during retirement. And for some reason, my mind just went to seeing a much larger picture. And this is the picture I drew. So it's really a nest of eggs, being plural. I think there's 13 here. And the top ones are what I call the tangible assets, your Social Security income, financial investments, real estate, your salary if you're still working, what the expenses are, and insurance protection. And there's many other tangible assets. But the intangible assets below the red line are all the assets about our life and our personalities, that drive and create the tangible assets. So our prosperity thinking, our creativity and imagination, lifelong learning, one's spiritual life, your health, having a certain amount of grit, which is a can-do attitude, and most importantly, your community of family and friends. So all of those intangible assets will drive the tangible. And I just like this slide because it gives people a much larger frame of how to think about financial planning and what you can control and how you can learn. I just think it's a bigger picture. So, and in that context, the insurance piece is a very important piece, like you both were saying earlier. I specialize probably most primarily in life insurance, and would be happy to answer questions. Maybe I think Judy has some questions for me, and I'll talk about that in general.
Right. Well, I mean, I think most people, when they think of life insurance, they think of a policy that will protect their loved ones when they die, and that the older they get, maybe they don't need it as much. But and maybe that they can't even get it. So, what types of life insurance policies are available? We're talking primarily right now to people who are considering downsizing. So, let's say 50 years old and up. What kind of, if you don't
Right.
have one, and or maybe you want to make sure you have the right one, what kind of policies are we talking about here?
Okay. And Dennis, maybe we can take the graphic down now so our faces are closer to each other. Perfect. Thank you. Um, so in general, there are two major categories of life insurance, cash value and term insurance. And insurance companies also sell another type of contract called annuities. That contract is a very different agreement than a life insurance policy. So life insurance policies, both cash value and term, basically have the contract between the individual and the insurance company that if the insured dies, then the company will pay off whatever the death benefit is that the um, client chose to purchase. So you buy any kind of life insurance, not just with money, but also with your age and your health status. So because it's all about actuarial science, and that's all about risk. So the insurance company is always looking at the question of what is the likelihood or what are the chances that this person who has applied for a policy with us is going to die and will have to pay off a large death benefit. So the younger one is and the healthier one is, then the less risk is involved that that's going to happen anytime soon. Hence, the premiums are lower.
Mhm.
So that can be very significant. In general, term insurance, which promises to stay level for a certain length of time, the term, is less expensive by about 2.5 times than cash value insurance. And there's universal life is the most popular type of cash value insurance, and it builds cash over time with a part of that higher premium going into the account value of the insurance policy. So it's like a
An
automatic
account that
savings account that you're creating that the policyholder has a legal right to borrow from if you needed to. And then of course it's wisest to pay that cash value back after your emergency is over. But a life insurance policy, either one, can be a tremendous tool to create, to protect one's assets, to protect your family, and to create much more diversification than you would have otherwise. Because if you need money and you just basically have your 401k and an IRA, if you need money, then you're going to be liquidating some of your stocks, and that will affect those portfolios. And you just have much a way to pad and protect those assets if you had some emergencies come up.
Are you talking
Um,
about just the cash policy? Or are you talking about a term policy as well?
well, there's a fairly new type of strategies that apply to both term and cash value policies that a few carriers, not all carriers or insurance companies I call carriers, issue. But one of my favorite companies, for example, is North American. And you can have either a term or a cash value policy. And if you have um, long-term care issues or a critical illness, you can get an advance against the death benefit of. So if you had a policy with a death benefit of a 500,000, well, they would do an assessment of what is your issue at the time that you want some money out of it, and it could range anywhere from 5 to 24% of the death benefit that you could just take that money out of the death benefit and use on your expenses.
Is
And
that
unlike
tied to your age at all, or is that just comes with the policy if
it
something
comes with,
happens?
by and
Yeah.
large, it comes with the contract.
Okay.
Right. It comes with any of the term or long-term care or cash value policies that they would issue, providing your health is minimally positive. If you're
Mhm.
really very unhealthy, then you'll be rated and you'll be paying higher premiums, and then they do not provide this rider of critical care and chronic illness riders.
Okay.
But their top three categories of health underwriting are preferred best, preferred, and standard, and then whether or not you're a smoker or non-smoker. So if you're in one of those categories, these are free riders that come with the contract with North American and a few other companies as well, but it's not across the board. So that's
Question, Libby.
been a development that I like a lot.
Question is, so at the time you purchased the policy, they're evaluating your health. Is that what we're saying?
Yeah, in general, with a life insurance policy, you are going to get a health rating classification, and the company will pay for a health exam, and one of our companies, paramed companies, will come out to your house and take a health history and maybe blood sample and urine sample. We'll do the labs and send that information into the company, who will say, okay, Mr. Smith, we will give you a rating of X based on your health exam and other information about you. So that's true of a lot of insurance policies in general, depending upon what the person's age is and how much of a death benefit you want. It may be where you are younger, and I mean younger, even under 70 years old, and your health rating, your health history looks good enough to where they'll give you a good rating, and those two writers I talked about. Maybe your question pertained to the writers. When you want to exercise the rider, you will then talk with the company, and they'll ask you questions about your then health condition, but to determine how much of the death benefit you can get advanced between 5 and 24%. But the policy would have been issued long before then.
I
I
see.
think that's a part of insurance. I mean, I didn't know anything about that, and you said it was relatively new. And from the standpoint of being someone who's downsizing and suddenly you're going to be relying on more fixed income, you're probably not going to be working, you're retired. I love that idea of this policy that if there was an emergency health issue, that you could get some of that money up front. I think that's something that a lot of people may not know about. And you mentioned 70 years old. Is there an age limit to where you cannot get that?
Yes, on cash value policies, the general issue age in the top range is 90.
Oh my.
Uh, on term insurance, you can still get it at 75, 80, 85 years old, but they decrease the length of the time of the term.
Oh, okay.
So
Can
maybe
you
it
give an example?
totals 80, maybe you apply at 80 and you can only get it for a 5-year term.
Okay.
If
And then
you
at the
are,
end of that term, you're done. That policy is gone, right?
Technically, what happens with a term policy is that at the end of the term, well, for the whole term, the premium has stayed level.
Mm-hmm.
And then at the end of the term, it converts to what's called annual renewable term. And each year, then the premium significantly goes up. So one would not want to keep that term policy if you're healthy enough to get another one,
Mm-hmm.
because it would be cheaper to get a new one and start with a new term. But if you're not healthy, you as the policyholder have the right to say, no, I really want to continue this. And even though it was only a 10-year term and I'm going to be 80 years old, but I've got cancer and I don't think I'm going to last much more than a year, you might go to your beneficiaries and say, hey, let's all pony up to pay the premium, because it's going to be 4 or 5 times more of what you were paying before.
So can you give an
So,
example of what it would be? And let's say someone 55 years old in good health got one of these term policies and then decided to hold on to it after it expired. Can you kind of give an example of I'm
well,
at
that's scary because I need a computer to figure
oh okay.
that out. But I would just to give you ratios, I would say, first of all, you have to ask the question, how much is the death benefit?
Okay.
So, because that totally drives the premium. So
Mhm.
let's say the death benefit was 250,000. It's a 50-year-old person. It might be like $150 a month premium. And I'm just really guessing there.
Yeah, yeah, that this is not
It,
sealed in stone. This is
right.
just
So
hypothetical.
if at the end of the term that $150 a month premium will jump to like $900,
mm,
Oh
it'll
my.
jump significantly. And that's because they are trying to get rid of that risk. They want
Okay.
that policy off the books. However, it is up to the policyholder. And if you now know that you are not healthy and you want to keep it in force, you might call on your family to help pay the premium, because the ball's in your court in terms of that decision.
Yeah, and it might be worth the money to put it out there.
Yeah, and
You know, be
you
around
wouldn't
for
keep
years.
it if you were serious. If you knew you were seriously ill, you might want to keep it
Mhm,
so it would pay off the death benefit, which could be, many more times the amount of premium you ever paid into it.
mhm.
Libby,
So,
can I, Libby, I wanted
yeah,
to go back to the borrowing against your policy, because if you do pull some money out from that death benefit, are you required to pay it back until you die, or is your benefit reduced at if you did die?
Yeah, again, you can pull cash out if you have a cash value policy, not a
Mhm.
term policy. Um, and and if you are not required to pay that money back, but depending upon the numbers, and you can always get what's called an in-force illustration. So you ask the insurance company, okay, what if I wanted to pull $10,000 out of the cash value? How would that affect the policy? And you'll get an illustration
I see.
into the future to give you those answers. So yes, it could reduce the death benefit, And if you didn't pay the cash value back, the cash back, um, or if you borrowed too much, it could collapse the policy.
Mm.
So any policy has to have enough in it to pay for the cost of insurance and the expenses of the insurance company. So, but that's well within a ratio, and the good carriers, in my opinion, give you plenty of information on how to watch those ratios.
Thank you.
How do people determine how much they need? You were talking about, the value of the policy. Is there,
Right.
can you help them make that decision, or did they?
Yeah, we have financial inventories, a financial inventory of, how much are your expenses, um, how much is your mortgage, how old are you, a whole list of questions, doing an inventory. And then that's will come up as a number as to what is your monthly nut, if you will. And then maybe you'll use a multiple of 5 or 10 to say, okay, I really need a 500,000 or $1 million death benefit
Mhm.
to take care of my survivors, um, in the style to which they've become accustomed, or whatever style you want them to become accustomed to.
You mentioned annuities. What is can you explain the difference? But I mean, is that
Right.
something you should consider in lieu of a life insurance policy, or in
Yeah,
addition? Or,
there's a lot of interesting differences between the two contracts. First of all, an annuity, unlike a life insurance policy, is not health related at all, nor is so you don't buy the premium with your health. It's really a very flexible savings vehicle when you want to diversify your savings. Let's say most of your money is in the stock market, and you aren't comfortable with the volatility, and you should diversify. And maybe you got an inheritance and you want to keep that money safe, and yet make sure it's earning better than a savings bond or something at the bank. So you could purchase a single lump sum annuity, and you just sock it away, and then it can grow again by there are what we call an indexed annuity, like there's an index life insurance policy. And what that is it will track the S&P 500. An index is used by the insurance company to determine how much interest will be credited to that contract every year. And what they do, the beautiful thing about this on both types of contracts, is the account value will either be going up each year, or if there's a crash in the market, in the stock market, it will stay even. It won't go down.
okay.
Unlike your 401k or any money in the market goes up and down with the volatility of the market. But an indexed annuity or an indexed cash value life insurance policy, the account value is actually in a side fund, um, of the insurance company, and it's not actually in the stock market.
Okay.
They have staffs that play options
Mhm.
and will be able to credit either on an annualized basis the gain in a year's period of time of the S&P 500, or you will get zero, but that's when zero is your hero, meaning you didn't have to take a hit.
Mhm.
So your cash value stays the same, and then the next year market has a gain, and so you're going up from an even position rather than a down position.
So an annuity is your money. You're putting the money into it just as you would be
Right.
paying a life insurance policy, but it's there no matter what, and it grows based on the interest that is accumulated by the investments or what they do within the market. And then if the market crashes, you don't lose anything, as you said.
Right.
So if you buy $100,000 annuity, you're putting $100,000 into this over a period of time, right?
Or you could do it as a lump sum, or you could do it monthly or quarterly. Yeah,
Okay.
there's various types of annuities in terms of how often you pay the premium. Maybe it's just a single one-time premium, but you can, so it's a contract with what I call Daddy Warbucks, who has a lot of a large life insurance company. And all of a sudden, I've got a contract or an agreement where I'm guaranteed at least the amount of money that I put into it, but also probably more based on how the account value gains or how it's credited, the annual crediting rate. The other thing is that you can borrow up to 10% of the account value without um, taking a surrender hit. Annuities come with a surrender period that go like for 10 years, oftentimes, or a 7 year, but it might be 9, 8, 7, 6, 5. It decreases by 1%
Hmm.
until it's zero in the 10th year. But during those first 10 years, you can still use up to 10%
Oh,
typically.
okay. And at that
And
zero
that's
point, are you expected to pull that money out of the annuity then?
no, you can leave it and let it continue to do what it was doing, or you can annuitize it. And to annuitize it is basically, okay, saying, I want to switch from the accumulation phase and go into the distribution phase.
Oh, okay.
And then you're deciding how do you want to receive that money out, including the account value, the crediting amounts that it grew to.
So if someone had an overriding health issue, they might want to consider doing an annuity instead of a life insurance policy because that health piece of it is not a piece of the puzzle, and
Right,
they still over a period of time be able to generate income for when they're gone or even before, more so
right,
than a term policy or okay.
right. So it's just another tool that is, certainly worthy of being aware of. And getting back to the concepts that I showed at the first slide, is the name of the game is diversification.
Hmm.
I never say to clients, oh, you shouldn't be in the market. What I do say to clients is, in my opinion, you should not be 100% in the market.
Hmm.
And there's an old financial um, planning formula that is very simple, and that is to take your age that you are and subtract it from the number 100. And the answer is how much money you might want to consider having in the market.
Mm.
So if you're 50 years old, of your assets, you might want to keep 50% in the market, but then as you age, that number is going to go down. And it's all based on the theory that if there is a major market correction, you're going to have fewer and fewer years. You'll have less time to get that money back.
Okay.
And
So, but with insurance, um, it's either protecting your other assets or providing income for your loved ones, and in some cases yourself, like the writers I talked about. And an annuity is simply another form of a savings vehicle that has a lot of flexibility to it.
Libby, if you take money out of your annuity, are you hit with a capital gains?
You can be hit with a capital gains tax depending upon how large it is, how much, the before the capital gains tax kicks in,
I see.
and whether or not the annuity itself is set up as an IRA, which is money that you never paid taxes on. So yes, you'll have to pay tax on the whole thing when you start drawing it out. If it's set up with after-tax dollars, where it's not an IRA, it's just a plain old annuity, then you'll have to pay tax on the amount of the gain only, not the principal.
Okay. Okay.
So it's, yeah.
And are are there any health restrictions that you know of that automatically bar you from buying a life insurance policy?
Um, there's really very few. I mean, if you're diagnosed with a current case of cancer, that might knock you out of the park for a while. But generally speaking, you can get a policy. It's a question of what is your health underwriting rating going to be, and that will determine one of the major elements of what determines the premium. So many insurance companies go up to a table 10. So that's you have your preferred best, preferred standard, and then standard. So three top categories. And then under that are tables 1 through 10, which is determined by the underwriter as to what are your health issues.
So
And
you're going to have
so,
I'm sorry, continue.
well, you have to have pretty serious illnesses before you
Mhm.
can't have a contract at all. And this will vary from company to company also.
Okay.
So
And so is
it's
it, as your job, are you looking, do you go from company to company if you have, issues trying to find the best policy for people?
Yes,
Okay.
that is the role that the agent, especially the independent agent, which is what I am.
Mhm.
In the world of insurance, it used to be when my father was a life insurance agent, you were a captive agent and you could only sell for, like my father was with Bankers Life of Des Moines, Iowa. He was a captive agent. Or New York Life still has captive agents, or Mass Mutual, and but then in the meantime, many insurance carriers have said, "Oh, this is too expensive and piece of overhead for us. Let's just try and capture as many independent agents who want to do business with us." So what happened, a new organization was created called IMOs, Independent Marketing Organizations. And I've got a great um, um, IMO named Pacific Insurance in Bellevue with a really great staff. And so what they do is they want to establish relationships with as many independent agents like myself as possible. And to do that, they will provide ongoing training, like a weekly or monthly seminar. They will keep up, their staffs keep up on new product knowledge. They they watch the underwriting, they do my back office work. So when I turn in a policy, they then shepherd that policy through the carrier that they thought was most likely to give the best deal or the best offer to the client. And they will know, like, my IMO has, I would say, an active relationship with about 20 carriers, and they probably have 600 agents across the country under their wing. And so they bring a lot of influence to those carriers to place that business. And they will know which of the carriers have what type of products, and have better tolerance for certain health conditions than others. And so it's this whole level of knowledge that the IMO brings to me, the independent agent, because they want my business. And then they can say, okay, out of, I think there's three or four companies that your client would do well with, but let's go in this order because this one's going to be the very best, and so on and so forth. So I follow their lead because their staff keeps up involved in those conversations with the carriers much more closely than I do.
Mm-hmm. So people should make sure that they're asking for an independent agent, or asking that question, are you an independent It's kind of like when we work with lenders, you can go to the bank and you get what the bank has to offer, but if you go to a mortgage broker, you have suddenly access to
It's
different programs, and
That's
they
exactly
kind
that
of
same
put it in
model.
the same
Right,
sort of situation.
Okay.
So it's
right.
important to ask if you were an independent. You think most people are, but there are still some that are not.
Yeah, there's still some large houses. And oftentimes when I'm competing against another agent, or they've bought a policy in the past from, let's say, a New York Life, um, that premium, is going to be higher than what I, as an independent agent, could get for the very same death benefit, um, and so on and so forth, because they've got to cover a sales force with certain income guarantees. As an independent agent, you don't get anything that way.
I know how that feels.
Probably like a real estate agent.
Well, that
Um,
that brings up the question then, Libby, how for all this work you do, how do you get paid?
I'm paid by the carrier, so I get a commission based on the policy, and that's all figured into the expense of the policy. So over time, the client is paying my commission, but it's all done through the carrier, and I'm paid, uh, when I place the policy and it's gone through underwriting and it's sealed deal.
Mm-hmm. So there's
But
not an out-of-pocket expense for your services.
no.
no, there's no
Okay.
expense, either uh, for me per se, or for the health exam.
Okay.
And they can have, of course, the results
Now,
themselves.
are there, you mentioned the health exam, and I have heard some pretty uh, pie in the sky insurance ads on different radio stations and whatnot, where you don't need a medical exam, or you can even have diabetes, or you can get a $2 million policy for $200 a month, even if you are 80 years old, and you begin to
Right.
wonder.
So what's going on there is the premiums of those promises are going to be much higher, quite significantly higher than carriers that do look at the actuarial risk. So it's all a matter, it's kind of like, I don't know, an elephant of who's holding an ear, who's holding a tail, you know. There's many different parts to it, but it's all the same variables when you look at the big picture. So yeah, you can get a um, policy that doesn't have underwriting, but you're going to be paying 2 or 3 times as much premium as that you might get from another company that does do underwriting. And because your degree of health is still better, and they're changing the health requirements. The other day, um, I learned that one of my carriers no longer has the issues that it once had with anxiety medication. or other psychological medications uh, within a certain tolerance.
Mhm.
So they used to do underwriting where if you had those in your medical record, that would drive the premium up a bit. And now that particular carrier is saying, no, that we're okay with that now. So things change like that. And that's a very good example of why I depend upon my IMO in Bellevue, is that Lauren and the other staff members there keep close track and have very active relationships with those underwriting staffs.
And I know at least in the state of Washington, we have a very robust insurance commissioner's office that, from the standpoint of title insurance, I know that it is monitored very, very closely. Does the same thing follow suit
Yes,
with
we're under
this
the
type of?
insurance commissioner's jurisdiction. We have to maintain our license and take an exam every 2 years and have continuing education hours. That is what the exam is based on every 2 years. You have to be licensed, pass an initial exam
But you
to
also,
get your
there's no
insurance
deals.
license.
You can't give someone a deal in
No.
insurance, because the insurance commissioner, if it's anything like what they do with title insurance, there's very strict guidelines as to, everybody is going to get a fair shot at it, no matter who you are, what you're doing. So,
Right. I, as an agent, don't have any ability to just arbitrarily say, okay, your premium is going to be such and such because I think you're such a wonderful person.
right.
No, that whole premium setting is based on your health, your age, and what that underwriter determines it to be. Now, um, my IMO can sort of influence their decision making in terms of, let's see what we can do for this person, as opposed to another company that may have no flexibility. But that's coming from the IMO's point of view and not that individual with the agent. The only way I, as the agent, can influence that is how much of a death benefit do you want?
Hmm.
We can move that up and down, and that will very much influence the premium.
Hmm.
So the first thing that we always want to know is, um, I get an illustration done, or I do on a term, I can do an illustration comparing for four different death benefit levels. I take that specific person with age such and such, and then I have the software spits out a matrix of different levels of underwriting, and you can see the annual premium and the monthly premium for each of the levels of death benefit.
Hmm.
And that'll give you an idea as to how much of a policy you want. And then you can just extrapolate that into the cash value by multiplying the figure by 2.5 or 3 times.
Hmm.
And so when does the exam occur? After that initial
The
process, or?
Yeah, so the first conversation would be with me and the agent and the client, and we would get a ballpark idea as to how much of a death benefit. We might look over some illustrations, and then I would say, okay, the first thing we need to do is find out from the carrier what their offer back to you is going to be. So to do that, we have to get the paramed exam done and a health history. So I make the appointment, the examiner comes out to their house most often, does the exam. That goes back to the company, and in a week or so, I have what the company's offer is.
Okay.
And then we can get specific.
Okay.
Are there
Yeah.
any other types of customization that can be done to a life insurance policy beyond having that piece that in some instances you could draw from it if you had a health emergency? Anything
Right.
else?
So these are called riders, RIDERS. You can have a child rider. So if the parent gets insured for your child, I think under 18, for a very small amount, you can have a child insured. Another one is a rider to waive the premium during a period of disability.
Ah,
So if you are
Hmm.
technically disabled, the premium can be waived and the insurance policy stays in force. And then when you can start paying premium again, you don't have to catch up
ah,
what you didn't pay when you were ill. So those are two examples of riders
okay.
and how it can be customized.
So each rider, though, will add a little bit to the premium. Is that correct?
It can. Some
Mhm.
riders are free and some do charge a little bit and add to the premium. So other customization is often what is the purpose of the policy is often how it's, is this primarily for your protection for your spouse and children, or is this because you're in a business partnership? And if the one partner were to die, the other partner doesn't necessarily want to be in business with the former partner's spouse.
Mhm.
So a life insurance policy will pay off the community property claim of the surviving spouse.
And that's something that's important for people to understand. And you mentioned it to me, and I can't remember how you said it the other day, but there can be three different parties to a life insurance policy.
There are always three different parties. There's the
Okay.
owner, there's the insured, and then there's the beneficiary. Oftentimes, the owner and the insured are one and the same person, but they don't have to be. But the beneficiary always has to be somebody else.
Can you
Yeah.
have more than one beneficiary?
Oh, yes. You can have equal parts of, your four children. You can have an organization or your church
Hmm.
or a nonprofit. And then you can change your beneficiaries as often as you wish with a phone call to the insurance company.
Okay.
Cool.
So it's very
Um,
flexible that way.
and we talked to something. I'm not sure if you sell this product, but I, when you get your mortgage, when you buy a house, sometimes they offer you mortgage insurance, so that the mortgage would be completely paid off if you were to die. Is that something you deal with?
No, that's attached to your mortgage.
I see.
How we would deal with that, let's say you didn't have it, but you wanted that. So in doing the calculation to answer the question that Judy brought up of how much life insurance do I need? Well, if you want to include how much do I have left on my mortgage, let's say it's $200,000. Well, you could include that amount in determining how big a death benefit you need.
Okay.
So, you could uh, pay for it from that point of view, yes.
Okay.
But so then you wouldn't need to carry mortgage insurance if you have it figured in your life insurance policy.
Okay. Judy, do you have anything else for Libby?
I think that's it. I think you covered it beautifully, Libby. Your information I noticed is at the bottom of the handout that you gave us, the uh, um, nest eggs. and we will be posting that, correct?
Yes, we
Yes, I
will.
hope so.
Yes, we
Yeah.
will. So if people want to reach out to you, they can just reach out to either that phone number, and your email address is also on there, I believe.
Right, right.
Good.
And I'd also like to put in a plug for my Christmas book, How do the How do the Reindeer Fly?
She's
Judy's a
also
fan of
involved.
this.
That's right.
Yeah, Judy's a big fan of this book.
Yeah.
And I will send a picture of the cover to Dennis, so that will also be on the website.
Mhm.
Or I can show you a
Do you have
cover
the
of it
cover
right
right?
now.
Yeah, let's show
I
it.
I do.
Let's see.
So it's a shiny cover, so it's got a glare to it. But How do the Reindeer Fly, which came about because I served for about 6 years as Mrs. Claus, and a lot of kids asked us that question.
Hey,
So
thank you so much, Libby, for coming.
you're
Yes.
welcome. Thanks for
And
having me.
we really appreciate all this information. Well, like
Yeah,
we said, we will have a transcript of this with the podcast, and we'll have your information. I'll have images that will have your information on it as well. And that's about it. Judy, do you have anything to add before we sign off on our 24th episode?
No, we're almost up to a year, I believe. Well, or
Right.
yeah. If
and I
it's
think
two,
your
two a month,
podcast is just fantastic.
thank
I've
you.
listened to a number of the sessions, and you've done an excellent job providing a wide variety of information on, life changes that I think is excellent information at any stage in one's life here.
I'm kidding. I agree. And
Yeah.
I think we're at a year, Dennis. 24, two a month.
Yes.
Happy
So
anniversary to us.
would we need to go to 26? 26.
12 months.
Oh, you're absolutely right. This is wow. A year goes
So this
fast
is
when you're
Yes, we
having
should have
fun.
balloons and hats
this
and
is the
party
24th. This
favors.
is the
Good.
24th.
Yeah,
Wow.
you are
Of
1 year
yeah,
anniversary
for your
guest.
1-year birthday. Very
Yay.
good.
Yay. Yay to
Well,
us. That's all
please, anyone who wants to work with me, just give me a call, or if you're interested in my financial education seminar, I'd be happy to talk to you about that. And of course, my Christmas book.
All
I
right.
have a website by that name.
And
So thank you. Yeah.
thanks, Libby. Thanks, Judy. And thanks for
Dennis.
all our listeners for
Happy
joining
fall.
us for Getting Your Edge, How to Right Size Your Home and Life podcast. And we hope to see you in the future. This will be up on our YouTube channel as soon as possible, as well as the audio that you can find on Spotify, or Apple, or anywhere else that you get your podcasts. Okay, that's it. Bye-bye. Thanks so much.
Bye-bye. Thank you.